Behind every trade, every price shift, and every market trend lies an invisible force: algorithms. These computer-driven instructions execute decisions in milliseconds, shaping the behavior of global markets without human intervention. While investors often focus on news, fundamentals, and analyst predictions, algorithms quietly dominate trading, risk management, and market stability. In the modern financial system, algorithms are no longer just tools, they are actors. They analyze massive datasets, detect patterns invisible to humans, and make decisions faster than any trader could. From high-frequency trading to risk modeling, algorithms influence liquidity, volatility, and even the perception of value. The question for the next decade is profound. Who really controls global markets? The institutions, the investors, or the algorithms themselves? Understanding their power reveals how modern finance works, who benefits, and where risks lie. What are market algorithms? Market algorithms are computer programs that follow a set of rules to execute trades or analyze financial data. They can be simple, like executing a buy when a stock crosses a price threshold, or highly complex, using artificial intelligence to detect patterns across multiple markets simultaneously. These algorithms act faster than any human, processing billions of data points in real time. They respond to market movements, news events, and investor sentiment, often initiating trades before humans even recognize a trend. Their speed, precision, and adaptability give them enormous influence over market dynamics. In essence, algorithms are invisible market participants, making millions of decisions per second and shaping the financial ecosystem on a global scale. High-frequency trading. Speed as power. High-frequency trading is one of the most prominent ways algorithms dominate markets. HFT uses algorithms to execute thousands of trades per second, taking advantage of small price differences across exchanges. These trades may last milliseconds, but their cumulative impact is massive. HFT provides liquidity, reduces spreads, and can stabilize markets, but it also creates opportunities for manipulation and flash crashes. Investors and institutions increasingly rely on HFT algorithms, which has transformed market structure. In some exchanges, the majority of trades occur algorithmically, leaving traditional traders to compete in a system they cannot match in speed. Predictive analytics and market forecasting. Modern algorithms go beyond execution; they predict. Using artificial intelligence and machine learning, algorithms can analyze historical data, economic indicators, news sentiment, and social media trends to forecast market movements. These predictive tools allow institutions to anticipate trends, hedge risks, and identify opportunities before human analysts can react. The result is a financial system that reacts not only to reality, but also to algorithmic predictions of reality. The growing reliance on predictive analytics means that markets are increasingly influenced by anticipatory actions of algorithms, sometimes creating self-reinforcing trends or volatility. Algorithmic influence on stock prices. Algorithms can influence stock prices in subtle and profound ways. By executing trades based on technical indicators, algorithms can create price momentum, trigger stop-loss orders, and even exacerbate market swings. For example, a single algorithm detecting a downward trend may initiate massive selling, prompting other algorithms and human traders to react, amplifying the movement. Similarly, buying algorithms can create rapid price spikes. This phenomenon demonstrates that stock prices are not always purely reflections of fundamentals. They are shaped by algorithmic behavior, which can magnify market reactions in unpredictable ways. Risk management and portfolio optimization. Algorithms are critical for risk management. Financial institutions use algorithms to monitor exposures, rebalance portfolios, and comply with regulatory requirements. These systems can detect anomalies, evaluate correlations between assets, and adjust positions automatically to minimize risk. For investors, algorithmic risk management provides protection and efficiency, but it also introduces systemic dependencies. If an algorithm fails, it can have widespread consequences. As markets grow more complex, algorithmic risk management has become essential, but it also concentrates decision-making power in code rather than human judgment. The flash crash phenomenon. One of the most dramatic examples of algorithmic power is the flash crash, a sudden, extreme market drop followed by a rapid recovery. The most famous occurred in 2010 when the Dow Jones lost nearly 1,000 points in minutes. Flash crashes are often triggered by a cascade of algorithmic trades reacting to each other. What starts as a minor movement can be amplified as multiple algorithms execute similar strategies simultaneously. These events highlight both the efficiency and the danger of algorithmic markets. While they provide liquidity and speed, they also introduce vulnerabilities that can impact millions of investors in seconds. Dark pools and hidden trading algorithms. Dark pools are private exchanges where large trades occur away from public markets. Algorithms dominate these spaces, executing trades that would otherwise move markets if done openly. By using algorithms in dark pools, institutional investors can buy or sell massive quantities of assets with minimal market impact. However, the opacity also raises concerns about fairness and market manipulation, as not all participants have equal access or insight. The combination of dark pools and algorithms creates a hidden layer of market influence, giving certain players outsized control over price discovery. Global interconnectedness and systemic risk. Algorithms operate across global markets simultaneously. They monitor equities, bonds, commodities, and currencies, executing trades that react to international events in milliseconds. While this interconnectedness increases efficiency, it also creates systemic risk. A failure or misjudgment in one algorithm can ripple through multiple markets worldwide. Global financial systems are increasingly vulnerable to algorithm-driven cascades, where speed and automation amplify consequences far beyond any individual trader's control. Investors and regulators must understand this interconnection to mitigate risks in an algorithm-driven ecosystem. Regulatory challenges and algorithmic oversight. Regulators face a growing challenge in monitoring algorithmic markets. Traditional rules designed for human traders struggle to account for the speed, complexity, and opacity of modern algorithms. Issues include manipulation of market prices, front-running trades, unintended market disruptions, conflicts of interest in proprietary trading. Regulatory bodies are now exploring algorithmic audits, circuit breakers, and reporting requirements to ensure stability and fairness. Balancing innovation with oversight is a delicate task in a system increasingly dominated by code, ethical implications, and market control. Algorithms raise ethical questions about fairness, access, and accountability. When trading decisions are made in milliseconds by machines, transparency is limited, and human oversight is often minimal. Large institutions with advanced algorithms gain a structural advantage over smaller investors. This concentration of power challenges the principles of fair and open markets, raising questions about who truly controls financial systems. Ethical investment and regulatory frameworks will be essential to prevent abuse and maintain trust in markets dominated by algorithmic activity. The role of artificial intelligence. Artificial intelligence takes algorithmic trading to the next level. AI systems can learn from data, adapt strategies dynamically, and predict market movements with increasing accuracy. AI-driven algorithms are used not just for trading, but for credit scoring, fraud detection, and portfolio optimization. The rise of AI means that financial decisions are increasingly made by systems capable of autonomous reasoning, reshaping the landscape of investing and risk management. The power of AI in finance underscores the growing influence of algorithms not only on markets, but on the future of economic decision-making. Retail investors and algorithmic markets. While algorithms dominate institutional trading, retail investors are not excluded. Robo-advisors, algorithmic trading apps, and AI-powered financial platforms give individuals access to sophisticated strategies once reserved for professionals. These tools democratize investing, but also expose individuals to the volatility and risks of algorithm-driven markets. Understanding algorithmic behavior is crucial for retail investors to avoid unexpected losses and to leverage opportunities effectively. Algorithmic influence has shifted the playing field, making financial literacy more critical than ever. Algorithms and behavioral finance. Algorithms also interact with human psychology. Market movements often trigger algorithmic responses that amplify fear, greed, and momentum. They influence human behavior indirectly, creating feedback loops that shape market sentiment and trends. Understanding this interaction is crucial for investors seeking to navigate the interplay of human emotion and machine logic in modern finance. The future of algorithmic influence. As technology advances, algorithmic influence will only grow. Quantum computing, faster data networks, and improved AI models will enable even more sophisticated trading and risk management systems. The next decade may see markets dominated by predictive, adaptive, and self-learning algorithms capable of influencing not just trades but entire financial ecosystems. Investors, institutions, and regulators must adapt to this reality to harness opportunities while mitigating risks. The power of algorithms will not disappear, it will evolve, shaping the global economy in ways we are only beginning to understand. Who controls global markets? Algorithms have shifted the balance of power in financial markets. They act faster, process more information, and react more efficiently than humans. They provide liquidity, drive innovation, and create opportunities, but they also introduce systemic risk, ethical dilemmas, and information asymmetry. The hidden power of algorithms means that markets are no longer fully human. Decisions made in milliseconds by machines can ripple through global economies, influencing wealth, investment, and risk. For investors, the key takeaway is clear. Understanding algorithms, their influence, and their limitations is no longer optional. In a world dominated by machine-driven markets, knowledge and adaptation are the ultimate competitive advantages. The next decade will reveal not just who wins in financial markets, but who controls them, and whether humans can keep pace with the silent power of algorithms shaping the global economy.